I like to try to make these webinars as comfortable as possible. So if you have questions, please, you don't have to wait until the end. I know some of you email me all sorts of questions all the time, which is great. I get a lot of email. If it's anything Trader related, I try to answer it myself. If it's anything as far as support or reinstallation with the Atlas line or the Trade Scalper or the mentorship students here that have joined me here today in the room as well, you guys know that I always offer um, support, but it does take probably a day to get back to everyone because of the overwhelming amount of email. So I do get back to everyone. If after this webinar anyone has any questions, please feel free to email me, but it will take about 24 hours for me to get back to you. I also have a new class starting October 23rd, and those of you who have joined up, look forward to starting 2 months working with you, learning all the methods. So if anyone here is interested in joining the next group mentorship class, which begins October 23rd, please email me. I can send you all the details, what we cover week by week, all the information to have everyone who's interested be able to make that decision. Everything is included in full support as well. So I see here a couple of questions, and let's take a look here to start off here. The entry for the double bar long is more than twice the ATR. Would you still take it? It's a great question. So let's first talk a little bit about this idea and this notion of overexhausted, overbought, oversold, right? What does that really mean? In my years that I've worked with traders, we have this notion that if they're very strong up or very strong down, it means the market is going to continue. But that's really not always the case, right? If you think about what happens after a big move, after a news event, typically the market doesn't continue right away. It may continue later on, but it's not as if it's a guarantee that it's just going to keep on going. So after the market makes a big move, a big run, sometimes it needs a little bit to catch its breath, right? So what I've seen time after time is that the best trades are not the ones that explode and you have, let's say, 2 or 3 bars that are very strong, whether up or down. Those are not the best trades because where you're entering is after the market has already made a big move. So the idea is not to go in after the big move. The idea is to get in on the way up as this move is happening or at the start of it. Sometimes you just can't get it. Sometimes the market, based on news or any other situation, will move very strong up or down, and you get in after the fact, and then the market has nowhere to go. There's no additional push, right? And you need that push. You need buyers to continue. So if you think about all the buyers that are already in it, they are already in it. The market made its move. So the idea of this overbought, oversold has to be incorporated when trading. We have to think about this. So if you look at, for example, what happened here, I give a recommendation that says, and I teach this as well, I say, how do I know that if I enter here at 1735 quarter, that the market has enough action or enough power to continue? Remember, entering here, it still has to move higher for us to be successful. So here's how I look at it. If I'm entering more than double the ATR from the Atlas line, and this is just for this double bar long trade, it becomes a higher risk trade, right? Because remember, the reason why we have this entry on the Atlas line, it's not anything secretive or magical. It's based off of price action. I always try to follow price when I enter long or short. So the reason for this entry here at 9:55 this morning is because 2 consecutive closes occurred as soon as the Atlas line began to plot. Now, if the market comes straight down and closes 2 consecutive closes below the Atlas line, down here, it's the same rule. I have 2 consecutive closes below the Atlas line. It's in order to go short. The reason for this price is always the closing price of the second candle. It's always the closing price of the second candle. So now you know why 1735 quarter. You should know that this is going to occur ahead of time, right? And after the market makes this move, I say to myself, what happened? What just happened? Am I entering at a place where the market may now take a little bit of a pause? So I look at this price, 1735 quarter. I look at where the Atlas line is plotting, and I look at the ATR right here. Now, for those of you who don't know about the average true range, about this ATR, it's located here. Every platform has it, right? It's located right here, the ATR, average true range. And I use a setting of 4 because I'm only interested in knowing what happened within the last 4 bars. This is very, very, very important. I can't stress to you how important this is. I know some of you are new traders here in the room. Some of you, know all about this because you follow my videos, and some of you are in the mentorship program, so I'm happy to see you guys in here. But really knowing what the current conditions are is of utmost importance. How do you know if the market's slow or fast or not tradable or too volatile? You have to look at something. You have to reference something. I reference the ATR, the average true range, and I'm only concerned about the last 4 bars, the last 4 candles. So if you look at this here, the last 4 completed bars, this one, this one, this one, and this one, these 4 right here, give me a great representation of what to expect moving forward in time. Now, obviously, it could be less a tick, plus a tick, but that's not really what I'm after. I'm after 2 points is exactly what I'm looking at as an expectation. So Ali has here a question here. What's the profit target? The profit target is based off the ATR, the average true range. And if that ATR tells me that on average the market can move 2 points, it means it could move 2 points up or down from this closing price. And so I look at this as a great guide. I can't expect 10 points. Maybe it'll move 10 points, but that's just a maybe or a hope. 2 points is an exact value that I can work with. So moving forward here, if my entry is 1735 quarter, Ali, my profit target is exactly 1737 quarter, 2 points from that entry. If this was telling me 1 point or 3 points or 10 points, it's all relative. Whether you're working with a daily chart, a monthly chart, a weekly chart, a 1-minute chart, it's completely relative. So you use the same settings. All right. Now back to this overbought, oversold explanation that I was going for. How do I know that if I'm entering here, I'm not entering wrong? Right. Okay, so I look at this as an over exhausted scenario if and only if my entry of 1735 quarter is more than double this ATR. So if this ATR is 4 points, I want to make sure that I'm referencing the Atlas line and 4 points, which would be 1734. So you can see that I'm using the current market conditions. I'm doubling the current market conditions, and I'm looking at this and saying I can enter long anywhere inside from here to here. This order occurred here. It becomes a higher risk trade. Not to say that it's not going higher later on. You can take pullbacks and strength trades and all those good things that come our way, or any other method like a blueprint or whatever. But for this point, for this trade right now, it becomes higher risk because you're entering at a place where it could potentially stop, pull back, take a little breather. And you can see right here, this is where we are right now. You can see right here that as soon as this made its move, right, let's say from here to here, double that ATR in a very short amount of time, what happened? Stopped, tried again, stopped, trying a third time. So it's very common to reference price action and incorporate it into how you trade. Following moving averages and momentum, it all sounds great, right? Because you can backtest it, you can optimize it to that perfect value. But it's not really that simple. And trading isn't really that simple. Trading, I think, although you can make a lot of money, you can also lose your money as well. So you have to be prepared and covered and not just go with the flow or follow the herd. In my opinion, and based on my analysis of the market, this market's going up. You've probably heard me say it all year. There's plenty of videos with me forecasting when to go long, why to go long. I'll cover that today as well. But most importantly, time your entries and then time your exits. For those of you who are trailing stops, I'll go over exactly how to trail stops today. That way you have a good reference on how to trail a stop instead of going long, and then as soon as it starts going up a little bit, you right away put it to break even. You're really putting a tight stop on that. Sometimes that's not the best way to go. Anyone have any questions on this overexhausted, over bought or oversold scenario? Again, I believe the best trades aren't ones that shoot up very, very high in a short amount of time or go down very fast. The best trades are ones that look like this. Let me just go here into the future. Let's say the Atlas line looks something like this. The best trades are the ones that once it crosses the Atlas line and retraces a little bit, like that, those are the best trades. The ones that, let's say it's a higher close and open, and then it retraces. The trades that are very strong, like so, typically when it moves double the ATR and you're entering long here, you have to remember the market still has to move higher from this value where you enter for you to be successful. Sometimes that is harder and it's a higher risk trade. Okay? Everyone okay so far? Yeah, Vidina. All right. Let's talk a little bit about a little bit more about the Atlas line, how to trail stops, how to do all that stuff. Here, I'll keep an eye on that. And also, stops are very, very important. Okay? If you're not using stops, you should. There's 3 stops that I use. Okay? No, Tom, you can trade a flat Atlas line. That's fine. Yes, you can. I don't have a problem with trading a flat Atlas line. It doesn't have to be on an angle. The angle up or down isn't as important as when price crosses it, Tom. Let's take a look a little bit here on how to manage trades. And this is yesterday. Okay, so I'm going to show you I'm going to reference to you what happened the last couple of days, what you could do, what are the opportunities here. Again, the reason why we had a short trade here is because 2 consecutive closes appeared below the Atlas line, and the closing price of the second candle, which is this guy right here, is the entry. So 1711 quarter is the entry to go short, right? That's first and foremost. How do you manage that trade? So again, you have to do a little bit of what are the current conditions, what can I expect, all that good stuff. So I look at this ATR, I say, market's about a point and a half working up and down and moving in about a point and a half range. So if I'm going to take this trade, it's got to be for a point and a half before I can even consider trailing a stop. But what if this market doesn't go down and it goes up and it has to stop me out? There's 3 stops that I reference. This is all included in the training as well. But the 3 stops are there to protect you, whichever and however situation may arise. So let's talk a little bit about time. The longer you hold a trade or a losing trade, the worse off you are. Because we entered for a very specific reason. And if that doesn't result in a very, not a very, but in a continuous move to the downside for you to be successful in this trade, what's the likelihood that it's going to happen 2 hours from now or 3 hours from now? It may not go in your direction. So I like to use 4 to 5 bars maximum as a time-based stop that says if I enter here within the next 4 to 5 bars, I want to absolutely make sure that I either reached my profit target or I'm in profit target territory, or if this is going nowhere, it's just starting to channel or whipsaw, I'm going to cut my losses. I'm going to take that stop, whether it be 1 point or 2 points or 3 ticks or a 3 tick target or a 1 tick profit target, whatever the case may be, at the end of the next 4 bars, which is 20, 25 minutes, then I'm out of the trade, period. That way, it really locks me into place instead of holding on to a losing trade. And we've all been there, me included, where you start moving your stops and you say, no, no, it's got to turn around at any point, and it just keeps on going and going against you. I'm trying to avoid that. What could be a manageable stop where you lose a point or 2 points and you say, you know what, the next trade I can make that back, I don't want that to turn into a catastrophe. So I really lock myself into a time-based stop. And if this trade's going to work, you should make your profit target within the next 4 bars. If it's not, cut it loose. The next stop that I use is called a prove it stop. And the prove it stop, again, whichever stop occurs first, the prove it stop basically says, well, if I have some evidence or proof that this market is not going in my direction, why am I going to hold on to this trade, right? I have proof otherwise that I should be going long or that I should, get out of this short trade. So the prove it stop that I use in this specific Atlas line, the prove it stops are different for all the methods that I have, but for the Atlas line, we're looking at the first closing price on the opposite side of the Atlas line. So if I go short and there's a candle that closes, the next candle, or within the next 4 to 5 bars, closes above 1713 quarter, or wherever the Atlas line may be at that time, that's an automatic stop. I say to myself, the market's not going down, it's closing back or going higher. I'm automatically out of this trade with a prove it stop. Last but not least, I have what's called a catastrophic stop. And this to me is also very important because even though we look at news reports and everyone should be looking at some type of economic calendar, I have a page on the Day Trade to Win website that is free software for everyone to download. So I have there 2 calendars, one for NinjaTrader, one is a web page. And you don't have to use the Day Trade to Win news calendar. You can use any calendar, but at least reference when we have FOMC, when we have housing, PPI, when Bernanke's speaking. All those things we know in advance, and they could very easily move the market up or down very chaotically. I don't want to be caught in that kind of situation. So at least you know when a news event's going to come out. Maybe stand back and say, I'm not going to trade until this news gets released and everyone goes long or short. And then at that point, I can go long or short after the news. Okay, after the news. Okay, next, how do I know what the catastrophic stop is? The catastrophic stop, right, as long as there's not a news event, is based on having a stop that's double the market condition. So if the market condition is a point and a half or 6 ticks, I am going to double that to 12 ticks. So I'm going to risk a maximum of 12 ticks. So a catastrophic stop is double the ATR. Okay. Okay, catastrophic stop. All right, now Yesterday, the first trade of the day was a losing trade, and your exit is here, period. The next trade was two consecutive candles closing above 1713 quarter, 1713 quarter. The closer you are to the Atlas line and taking it up, that's a much better trade. Or taking it down, the closer you are, take it down, it's a much better trade, as opposed to what we spoke about earlier, two candles that are really, really strong, and now you're going short this distance away. That is not the best trade. The best trades are when they're nice and close and take it up. Okay, so here's a long trade, kept on going higher and higher. If you want to trail a stop, let me show you how I do it. You may have a different variation of it, but this is how I like to trail a stop. And so a 6 ticks, well actually it would be, 7 ticks, 6, 7 ticks within the next 4 to 5 bars, time-based stop, or prove it stop, or catastrophic stop, is how I manage this trade. So this was done with the next few bars here, but then what? So let me show you how to trail a stop. I'm going to go here into the future here. If you enter here, right? If you enter here, and the market starts to go up, you know, based on the current conditions here of the ATR, that you should make 1 times the ATR. 1 times the ATR, right? For a profit target. It has to at least reach that. After the market begins to move higher, and after you realize that it made 1 times the ATR, this is how and why you would want to trail a stop. The way to do this right is you have to trade with at least 2 contracts. So 1 contract, or half of your position, right? So if you trade with 4 contracts, half of your position will be 2. You would exit 1 times the ATR. You'd exit wherever 1 times the ATR would be. So you're left with 1 remaining contract. This remaining contract is the one that's going to be the runner, or the one that you're going to trail. Where you put the stop, though, for that remaining contract is important, because what a lot of traders do, as soon as it moves like that, you place that stop on that 1 remaining contract right at entry. So let's say this is your entry. And I say it's too tight. I already know, based on the current conditions, that the market can move up or down 6 ticks or 7 ticks or 2 points, whatever the conditions of the ATR happen to be. So if you place your stop on that remaining contract right at entry, thinking that I don't want to lose any money, you may be shortchanging yourself, because the market does need room to breathe. It's after it makes this profit target and you're out of half of your position, it may come down, it may go up, it may hang around here for a little bit. You can't have it equal to or less than the ATR, because you're just setting yourself up to get stopped out prematurely. Excuse me. So instead, what I like to do is I like to place the remainder stop not at where I entered, but equidistant to the profit I just made. So if I made 2 points on half of my position, this is where my entry is here. Let's say right here. I am placing the stop on the remainder half of my position, 2 points below my entry. So I made 2 points. My stop is going to be 2 points in the opposite direction. That means that if this is really and truly going to keep on going and going and going, I am going to have my stop here. I'm not going to put my stop at entry. Is everyone clear on that concept of not having a stop, if you're really wanting this thing to continue higher that tight, it has to be in the opposite direction equal to what you just made. Are you going to make any money on this trade if it comes all the way back down from here to here? The answer is no. But you're also not going to lose any money. The concept is not to lose any money, to give it an opportunity to run, especially knowing that the market's going to continue higher and higher, whether it's based on the news, whether it's based on the January effect that I teach everyone. So really the idea is to let it go, but having your stop large enough to keep you in the market. After this makes 2 times the ATR, you can move your stop. Let me change that color. You can move your stop here, right? Because now it made 2 times the ATR, another 2 points. If it makes another 2 points, move your stop to here, and so on and so on. So you're always behind, or let's say double the ATR in the opposite direction as far as a runner or trailing that target, trailing that stop. But to start it off, you have to at least, to start this whole process off, you have to at least make 1 times the ATR and let that remainder position run. Okay? Is everyone clear on that? Anyone have any questions on trailing a stop, the idea of using 2 contracts, getting out at half, putting the other half opposite what you just made, and then letting it go? All right, good. All right, let's talk a little bit about the time-based stop. The entry, 1735 quarter, is right here. So even though this is a higher risk trade, and some traders, they want to take everything. God bless them. If they want to take it, take it. But manage it, right? So 1, 2, 3, 4. At the close of this candle, if you were unable to make that target of 2 points, this is where you cut it loose, right? So that time-based stop to me is very important. Thanks, Sean. How are you, Sean? Good to hear from you, man. All right, so that's the time-based stop. So I covered time-based stop. I covered how to trail a stop. I want to show you what happened recently in the market. If everyone lost that video, I watched that video that I put out a couple days ago about the market moving higher. It was expected, no surprise. Let me just change this here to a daily chart. I should be able to bring up a daily chart. And I'm going to just delete everything here so it doesn't clutter us. So what's to be expected as we move forward, right, in the next move, right, towards the end of the year? Well, last year and this year, I've been saying that, the market is poised to just keep on going higher and higher. So there's 2 ways that you can play this. You can just buy it at the end of January, and if it continues to move higher, you just got to hold on to it, or options, or a December 2013 contract and see where we are at the end of December. That's not really, for everyone, it's not really the right way to go, because if the market goes down 30 or 40 points, I don't want you to be a sucker holding on to this for 30 or 40 points, and then it'll come back in the middle of the year, right? It could very well happen. So that's obviously not for everyone to do something like that, right? To hold on to it until the end of the year. But what about looking at a strategy where every time the market pulls back and then breaks the highs, you have an opportunity to jump in. You have plenty of time. This isn't typically, doesn't really happen overnight or within minutes. You can definitely time it right. So let's take a look at the entire year here and just give you a good breakdown of what happened, what some of the traders took, the opportunities that exist based on this idea that if we have January closing higher for the month, January 1st to January 31st, you see that it was an up month, right? So this is where January ended, kind of like this, right? Okay, and by the way, I'm showing you something on a daily chart, and this is price action, right? There's no special indicators or anything here. I want everyone here to think about how you may be able to apply this on a trending day, on on a time frame that doesn't have to be daily, but it could be hourly, or 5 minute, or whatever the case may be. What I'm showing you here is based on a larger time frame, week, a year, out of the year. Look what happened using daily candles. Apply this method to a day trading time frame, kind of the same idea, right? So I want to broaden your horizons here a little bit. This doesn't have to be just on daily charts. Okay, so this here was an up month. And if you go back in history, and there is a lot of history, and it's not just the E-mini, it's the financials. You can go back to the Dow of the 1930s, all the way moving forward. If you have an up month here, expect the year, the entire year, to be a higher ending. So if you bought here, you can expect December that you are going to be in the money, right? Not for everyone. You can't just buy it here unless you're a hedge fund and get out at the end of December. So instead, look for the market to pull back, right? So for example, here is the highs of January. Every time the market pulls back, comes back up and breaks these highs by a point, 2 points, by a couple of ticks, you're long, right? You're long. History has said this is how it works whenever you have an up month in January. Okay, so market pulls back a little bit here, 2 days, comes back and breaks the January high, right? Buy it. Go long. You don't have to go long for 30 points or 20 points. I'm not even suggesting that. But can you take 5 or 10 points? I think you could, right? Okay. Market makes a new high here. Market pulls back. So then I started talking about this and saying, look, the market's pulling back. If it happens to come back and trade a couple of ticks, point, 2 points, breaks that high, buy it, right? So I put out a couple of videos, recommended it to everyone. Go long. You don't have to take 30 points. Take 5, right? Take something. It's there for you. Okay. Here, market put a new top in place. Came back a couple of days. What do you think happened? Again, same thing happened, right? Popped up. Retraced. Broke this high. Couple of ticks. Go long, right? Okay. Here's a new high that's put in place. Like so. Started to come back. I started talking about it again. If it comes back, and I don't know when, but if, you have an opportunity. So about a month later, this happened. And boom, you're long, right? I like to use the ATR mic. Yeah, yes, I do. Um, right? Larry, the answer is no. It's not. It doesn't work the same way for the lower. If it closes lower, Larry, for the month, can you just go short? It doesn't work as well or the same way. Okay, so I can't recommend that. It would make sense that it would, but it's not the case. Okay? All right. So you go long, right? And then you went long, 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 whether you took 2 points or 50 points, you had an opportunity. And they made a new high here in place. Market pulled back a couple of days, right? And so you have to reference this high. And all this bad news that was occurring, whether it's political or, well, it's really only political, right? That we hear, you know, the economy and, you know, everything else. So, you know, everybody was bearish in a sense. But this is, you know, to go short here and to follow a shorting method, it's no problem. The only thing that I'm concerned about, the only thing I'm going to look at is once it comes up and breaks this high, a couple of ticks, maybe a point, you go long. So it has no relevance, right, going long here with you taking anything short. Separately, you can go short. It's just this that I'm looking at. Okay, so it broke it, kept on going. Okay, there's 30 points there. Just take 5. The ATR is 12. I think if you're going to do anything and you're going to then try to trail it, take the ATR and then trail it from that point on, right? I mean, I think anybody would be happy with 11 points. I would be happy with 11 points in one trade, without a doubt. This here is 16 points. Okay, market makes, market stops here, retraces, goes again, comes all the way back down. Here's your new high, popped, kept on going. This is 24 points. This is 16 or 12. I'm sorry, 12. So if you're looking at a specific target, the ATR is here, 16 or 12, I should say, because we're looking at the prior candle before it closes. So the calculation is made on the last closing candle. So it's 12 points, 12 points. So when it broke, I can expect 12 points, right? So it went up 30 or 22, 24. Okay, comes down. Here's your new high. Here we are. So I put a video out on Monday, probably right around here, and said, look out, it's coming. Get ready. And I received probably 10, 15 emails, not too many emails, but a lot of you took this here, and I'm very happy for you. But some of you missed out on it. So this has been 100% this year, 100% last year, because you can all go back in 2012 and look at the January effect, because it was a higher close than open January, and the same thing occurred. So 100% is pretty good, I think. Obviously, I have to read the all famous disclaimer that it's not indicative of future results, right? But we have a good history that this does occur. Now, if you did miss it, I would rather you not jump in now because it's over, right? This is, at this point, was about 24 points, right? So 24 points would be from 25 to, well, it's actually not over, to 50. 24 points. So actually, it's not over. You're entering a little bit late, but your target, if you're basing it off the ATR, which I definitely recommend, is going to be here. 47, 48, just before it hits 50, I would get out before it hits 50. That's the target recommendation based on the ATR. Not that it's over, but you're jumping in a little bit late to the party. Larry, you okay with that? Yeah, if it's lower, meaning a lower close than a lower close in January, then no, Larry, I would not say that the same is true. The same is true. Okay, Larry, I wouldn't recommend that. All right. Now, when's the next opportunity? It may happen maybe in a month from now or closer to December as December closes out. You hear a lot of talk, and talk is cheap, right? Because all these news heads on TV say we're going to have a terrible Christmas and holiday season where everybody buys Black Friday. Maybe, right? Who knows? I don't know. They don't know either. But think about the market pulling back a couple of days and then breaking whatever high is put in place at this time. But it's got to, we got to see at least 2, 3, 4 days of it, reversing. We have people taking their profits based on it making new highs. It's going to happen. But as soon as it breaks, if it breaks, right? Go long. I'm expecting it to happen at least one more time until the end of the year. Okay, so you have an opportunity there to take advantage of it. All right, any questions? Larry, you good with this? How about Kirk, James, Ali, Adam, Tom, Mickey, Mike? Okay, so that is what can be expected. Okay. Okay. Let's take a look at, remove here everything off the chart, and all of these examples that I've shown you, the move was explosive. It just jumped. So if you're taking this trade, let's get back to the stops. A time-based stop of 4 days, or some type of proof, and obviously a catastrophic stop is always key, because if there's a terrorist attack in the world and you're long, the market may obviously negate this entire situation that I'm showing you, and it may just take a dump. And so you need to have some type of catastrophic stop in order to protect yourselves in case the market, something like that could happen, right? We never know. We know news events, but we don't know something out of the blue, like an earthquake or something, right? Something may occur. Let's go back to the 5-minute chart here, and let's take a look at what can be happening right here and right now. 2 consecutive closes, it has to be clear, to the downside is a shorting opportunity, right? So here you have this candle, which probably closed just under it by a tick, or right on the line. So I would be hesitant to go short here, but it has to be clear 2 consecutive closings below the Atlas line. Okay, so this may now begin to give you a little bit of a whipsaw channeling effect, but it has to be clear 2 consecutive closes before you decide to go short. Okay, the 2 time frames that I like for the Atlas line are the 5-minute as well as the 15-minute. No other time frame I think works as well as the 5 and the 15. They're both divisible by 5, which means if there's a breakout or if there's some type of major move that occurs on a 30-minute or a 60-minute or a 15-minute, you can catch it on the 5 or on the 15. Okay, so the same rules apply. Nothing changes whether you use a 5 or 15. Okay, so the 15-minute chart hasn't quite given us an order to go short just yet. This here is a long, which I think is exhausted, overbought. So I definitely recommend not taking that. Here is a 15-minute to go long. Here's a 15-minute to go long or go short. Here is a long. Here's a long that didn't work. And nothing here. This is a bounce. Here's a long. Let's go back to a 5-minute. And pullback trades and strength trades, let me just turn those on, are additional trades that are available. So that means that if you have this double bar long and then price begins to and continues to move higher and higher, it's not over. You have a trending day, which means that If the market moves higher, that's a if, you're only going to get the strength and pullback trades based on the market moving higher. Okay? There's a filter in place that looks at every previous trade, making sure that you're always moving higher, just to guarantee that this trend is healthy. If it's not healthy, we don't want to be and continue to go long. The same thing with this here. Okay, so you don't see any pullback or strength trades here, right? Even though price is above the Atlas line. And the reason why this doesn't happen is because it's referencing the last entry. Every entry needs to be higher. Actually, this is telling me something different. This is telling me that the market is going down, not up. Okay, so that's the reason for the strength in the pullback trades. It's referencing every entry needing to be higher. So it's really not based off of anything except for price. You're entering here, that's the price. You're entering here, that's the price. You're entering here, that's the price, and so on and so on. Okay. All right. Anyone have any questions? Now, there's a couple of things that I teach additionally. Besides the Atlas line, there are two scalping methods. One is a counter trend, and one is like a breakout method going with the trend. The trade scalper, the price action scalping method. There's the roadmap. There's the at the open. There's the blueprint trade, which is the same as the power price action. So I incorporate all of these strategies into one program, and that is the mentorship program starting October 23rd. Anyone has any questions on that, please don't hesitate to call me. I have a limited number of students that I put in the room, and so it's a nice small class for the next 8 weeks. All right. I'm also recording this, and I will be sending this out to everyone later on today, or definitely by Monday. It'll be on the blog. It'll be on the on YouTube, and you can review this and ask me any questions you may have after reviewing it. The entry is going to be on the third Tom, the third P, or the third S. So this is the entry here. The third P is the third candle in this pullback. This candle here, this candle here, this candle here, this candle here. What else we got? So that's the nothing here. Yep. And so it's this one here, Tom. Okay. All right. So that's this one. That's this one. This one. This one. This one. And again, time-based stop, prove it stop. It's actually a pivotal stop that I have on these pullback and strength trades here. All right. Any other questions? All right, guys. Thanks for spending this Friday morning with me. Have a great rest of your day, and I will hopefully talk to everyone soon. Take care now. Bye-bye. My name is John Paul, daytrade2win.com. The Atlas line and the results are on the Daytrade2Win website. Email me if you have any questions. Until next time, take care.